Hey everybody, I hope everyone is doing well and had a good day. And in this video, I'm going to review the Emini 5-minute chart for Tuesday, August 19th, 2025. I want to talk about the daily chart just quickly here. And it doesn't matter if we look at the .D, which shows RTH bars, or if we look at the ES, which shows the Globex extended trading hours. It's the same thing, you just get less gaps on this chart. What I want to talk about is the past maybe 5 bars. Here's what we had going into the day. The market's been in a strong bull trend. We have this, maybe it's a trend line break, not a very significant trend line break when we zoom out and maybe look down here. So the market's respecting this more broad, bigger trend line. But look at the resumption. Tight bull channel, but parabolic wedge. 1, 2, pause, 3, and now we're going sideways at the new high. I try to mention this every once in a while because it stuck with me. This is something I learned from Brad from his reviews, and that is when the market is far above the moving average, bulls are going to be impatient, meaning if you're going to pay above the average price, you need above average bullishness. I remember Al saying that in the trading room. And you got to ask yourself, is this above average bullishness? Back here, this was strong buying, strong bull breakout. But as soon as it starts to go sideways, we can vacuum down to the moving average. And that's similar to what's happening right here. Tight bull channel, pauses along the way, breaking out to a new high, but then we start going sideways for 3, 4 bars. At some point, the bulls who were buying momentum, no longer have momentum. We're going sideways far above the moving average. So bulls, they'll have to reduce their position size, reduce their risk. Their premise of momentum is no longer valid, and they'll look to take partial or full profits and look to buy lower. And the bears know that. So bears will sell, betting that the market is already in a trading range after this reversal and follow through with relatively big bear bars. And that if it is a trading range, the bottom might be down here. And if this is the bottom and this might be the top, we could fall all the way down here. So bears are scaling into shorts and bulls are exiting longs up here. There's also a second reversal. The tight channel had a pullback and resumption to a new high, and now we have a micro double top with a decent sell signal bar, which triggered yesterday. We can also see right off the bat with bar 1 today that volatility is expanding. Look at bar 1 compared to all of the bars yesterday to the left. And it's the biggest bar on the chart. It's certainly bigger than the average bar. And just again, right off the bat, the first 7 bars of the day, we've already went below the low and above the high of the prior day. To be fair, yesterday was a relatively small day. When you do have an outside day, which isn't really shown here, if we look at the .D chart, you can see the outside bar. Outside bars are more common after relatively small bars, smaller range, easier to go above and below the prior bar. What happened here on the open? Bar 1, bear breakout bar, below yesterday's low, but just barely closing below the low. So the bears need follow through. Otherwise, we might be at the bottom of a trading range. Reversal and follow through, 2 and 3. Bears, bar 1 should get a second leg down, but 2 and 3 also needs a second leg up. And because of that, there's probably buyers below 3. 3 is a low one short, but at the bottom of a trading range, and it's a couple bull bars. So the reality is that bears are not selling below bar 3. They're selling a deeper pullback in the sell zone of the trading range. So there's probably buyers below bar 3, and a second leg up is likely. So we trigger the sell, continue higher, 5, a bull breakout bar, and then a pause on 6, low 2 short, but still in the middle or lower third of the trading range, not ideal for selling. And then the buy vacuum on 7, testing the top of the trading range. 7 is a great looking bar for the bulls, but that's kind of taking it out of context. The bar itself is good, but what's the context? Where is it occurring? What's the leg count? Are we in a trend or are we in a trading range? Clearly the market is in a trading range. It's been sideways for the past 100 bars. And if we think about leg count or pushes, we rallied from bar 1 to bar 3, pulled back, rallied a second time, paused on 6, and then we have a third push on bar 7. So we already have 3 legs up or 2 legs, depending on how you count it. To me, this is 2 legs, 1, pull back, 2, but it's 3 pushes, 1, 2, 3. Like I said, 7's a good bar, but it's just barely breaking above the bars to the left, not even breaking above all the bars to the left. It's similar to bar 1. The bulls need follow through. This reminds me of a couple of, maybe last week. There's an example right here, actually. I'm not sure if this is the one I'm thinking of. I don't think it is, but you can see 1, 2, 3 legs up, and it's a great looking bull bar, but overlapping the prior bar, not breaking out above the bars to the left, and you can see the reaction. And I don't think that was the one that I was thinking about. It was this one I was thinking about, and I still have the line drawn. 1, 2, 3 legs up to the top of a trading range. It's bar 7 in this case as well. Great looking bull bar, but not breaking out above all the bars to the left. And when it did break out above all the bars to the left, the breakout bar was small. The bulls need follow through, and they didn't get it. So kind of a similar situation in all these cases. Bar 7, great looking bull bar, but forcing you to buy at the top of a trading range in leg 3. Or leg 2, second leg trap, 3 pushes, however you look at it. The reality, if we think about breakouts are at the heart of everything we do as traders. And we owe it to ourselves to understand breakouts and understand what's the bull case, what's the bear case, who's buying, who's selling, what's the trader's equation for both sides, what's the context. We know the context is 2 legs up, 3 pushes, top of a trading range, and bar 7 is a huge bull bar. It's the biggest bar on the chart. So big bar, big risk. If you buy the close of 7, stop below 7. 1 times your risk is all the way up here. Bulls need follow through. 80% of breakouts of trading ranges fail, so the math is against you. You're taking a 20% trade with 1-to-1 risk reward. That's a negative trader's equation. You can wait for confirmation. You can wait for the breakout to fail, because maybe bar 7 will get follow through. So some traders might wait for the next bar, which is a failed breakout. The bulls did not get follow through. We have a bear close on bar 8. Now we have an implied high 1 at the top of a trading range after, again, 2 legs, 3 pushes, trying to break out of a trading range. So probably sellers above bar 8 sell to close bar 8. And then outside down 9. Maybe not quite outside down. It looks like the highs are at the same price. So this is actually a non-strict outside bar where the highs are equal, but the low is below the low of the prior bar. Bear breakout 9, top of a trading range, second leg down, likely, and 7 is probably a buy climax, and it's more likely that we'll test the bottom of the bar before we go for a measured move up. So traders will fade the bar 7 breakout, entering on the bear breakout 9. You can sell to close, sell a pullback. 10's a high 1, sellers above. Small inside bar, sellers above, breakout mode, top of a trading range. Always in short. And then 12, a breakout, crossing the moving average. The problem with 12, it's another big bar, and it's forcing you to trade in the middle of the range. So not ideal. Middle of the range, usually a no trade zone. Generally speaking, you want to sell in the upper third, buy in the lower third, maybe take profits in the middle third. But 12, this is a simple leg Every high is at or below the low of the prior high down to bar 12. This is all, technically speaking, if we think about spike breaks, this is all leg 1. So this is all, bar 12 is probably going to get a second leg down. How do you enter? Instead of selling the close, you might enter on a pullback. Maybe you enter on a 50% pullback of the bar. Maybe you enter at a breakout point, the bar 10 low, and 13. Traders selling the midpoint get filled, selling at the bar 10 low, they get filled, looking for a second leg down. This is still a simple leg. Is 13 going to reverse 8 through 12? Probably not. We need a second leg down. This is too much selling. It needs a second piece. And by that, I mean the first reversal attempt is probably going to be minor, and at a minimum, the bears will probably get to the low of bar 13. And it ended up being a sell to close bar, and it quickly got there. The tight channel is continuing, still a micro channel, a simple leg. So even though there are 3 parts to it, the buying pressure is weak. There's only one bull bar that's not a doji, and this is all probably going to get a second leg down. Bar 1 is currently the low of the day, and we know that that only happens about 20% of the time. And it looks like this is developing into an expanding triangle opening range. We went down to a new low, rallied to a new high, coming back down with weak buying pressure, so probably get to the low of bar 1 at a minimum. And we got there on the very next bar. 15, 16 breaking out below yesterday's low and the low of bar 1, the low of the opening range. 16, a weak reversal attempt. It's a good looking bull bar, but relatively small and way too much selling with open gaps. So the first reversal here probably will be minor. It's a double bottom with 1 and 16, but it's low probability. Small bar, small risk, big reward, must have low probability. And then outside down 18. When I say low probability, I'm talking about the stop order buy above, and that's why if it's a low probability buy, it's a high probability sell. Rather than selling above the bull bar, 17, some traders might try to sell above 16, although they may not always get filled, which in this case, I don't think they were. So the breakout is continuing, growing, and still strong. We have a small pullback here, but this is still a breakout on a higher time frame. On the 15-minute chart, there has not been a pullback. So always in short, only want to look to sell. And with this much selling, this might be a leg in a trend. We have open gaps, we have big, strong bear bars, consecutive big bars. There's really no reason to buy here, even though you might count 1, pause, 2, pause, 3, and we may have a minor reversal. That's the best the bulls can hope for, is a trading range or a bear flag. Because yes, there are 3 pushes down, but this is a minor wedge. On the next time frame higher, you would not see the pauses, you would just see a strong bear breakout. So it's always in short, only want to be short. It's even okay to sell the close 18, use a wide stop, and look to sell more on a pullback. So we're probably getting some profit taking here. This looks like profit taking more than a reversal attempt by the bulls. This is a minor reversal. Low 2 short, 23, reasonable sell. Breakout gaps staying open. 1, pullback, 2 legs up. Maybe the bulls get 1 more leg up. If you're selling 23, the stop goes above 18 at a minimum. You don't put your stop above 23 or 22. That's a skunk stop. 24 outside up. And 25 a small follow-through bar. Kind of reminds me of that chart I showed from last week where you have 3 legs up. 1, 2, 3. Big bull bar, but lots of overlap. The next bar breaks out, but it's a much smaller bar. And 24, 25 look like decent bull bars. Looks like a decent breakout and follow-through. But when we put it into context, it's following this huge sell-off that's very likely to get a second leg down. Meaning they'll probably get a symmetrical second leg and at a minimum test the low of 19. So 24, 25, small follow through bar. 25 is more of a sell to close bar. 3 legs up against a major bear breakout. So this is a minor reversal. You only want to count legs when you're counting the minor legs. Everything in a trading range is minor. You count legs in trading ranges, but leg count in the direction of a major trend, not so important. That's why I'm saying 3 pushes down here, but the expectation is a minor reversal and then trend resumption, not a wedge bottom and then a major reversal back up to a new high. But in a trend, like this might be a bear trend, as we're getting many bars below the moving average, strong breakout leg, minor reversal. Trends are composed of breakouts and flags. You have trending portions and you have trading range or flag portions. And when the market's breaking out, it's trending, and when it's trying to reversal attempts, most reversal attempts become trend resumption patterns 80% of the time, or 80% of reversal attempts fail and become trend resumptions. And that's why a trading range or reversal attempt is a minor reversal. And when you're talking about a minor reversal, you can count legs, and we can count 3 legs up with spike breaks. So 19, 20, leg 1, 21, 22, leg 2, pullback, 24, 25 is leg 3. The expectation was a minor reversal after the 3 pushes down, but a very strong breakout second leg down, likely, which makes 26 really good context for a bear breakout. It's a low 3 in a bear trend. So you can sell the close 26, sell the pullback, but I think if any trader is buying for any reason, 26 is a bar that you have to get out below. And if it's a bar that bulls have to get out below, then it's a reasonable, always in short entry stop order for the bears. And we got trend resumption as it became a micro channel. 30 is a weak reversal attempt, or a weak double bottom with 19, probably sellers above. 30, doji bar, 29, a stronger bar, so sellers might come in above the last strong bear bar in the micro channel. But again, we're probably going to a new low. And we pulled back above that bar and then went to a new low. The trend resumption is too strong to be looking to buy, and we may actually get a measured move down. The bulls were hoping for a double bottom here, but instead, if they fail, we may get a measured move down based on the height of that flag. Plus, I said the bears will probably get a symmetrical second leg. If we take, let's say, from 12 to the low close of 18, you can see these are generally in the same area. And I really have to speed it up here. I can't go bar by bar all day, but we can see the market would reach both of those targets. And a little bit of a reaction there, 45. 45 is a really strong bull bar. And it is 3 legs down at that point. 1, 2, 3. The last one subdividing into 2 legs. And 45 is a very strong bull bar at a measured move target. But 45 is more of a bar that bears might look to take profits above or somewhere in this area. But as far as buying, do you really want to buy against such a tight bear channel? Probably not. Similar to here, this is all just a breakout on the higher time frame. So it's still always in short. But because of context at a measured move target and a strong bar, maybe the market is transitioning into a trading range and becoming always in long. But dangerous to be buying here. And the bulls would end up getting looks like an 8-bar micro channel. However, it's still a minor reversal. And you can say we went above the high of 41, which was a major lower high, breakout, pullback, breakout to a new low, and we went above that high. And when that happens, the market is either in a bull trend or a trading range. But with this much selling and this little buying pressure, it's probably a trading range at that point. But if it is a trading range, that means there's probably buyers at a new low. And if it is a trading range, sure, it's an 8-bar micro channel for the bulls, but you don't want to be buying at resistance. You're buying at a lower high, you're buying at the moving average, not the buy zone. If you're looking to buy, it's a trading range, you buy at the lows. you might buy below 45 or at a new low. Sell vacuum 55 testing the lows, but probably buyers below at this point. It's a bear channel or a trading range at this point. There's too much buying here for this to be a strong bear trend at this point, but it may be a bear channel or a trading range. And we've had a couple legs down to the lows, and it looks like we're finding support. We bounced on 55, 56, finding support again at the lows as the market transitions into a more broad channel. So buyers at a new low. Reversing up 70, 71. If it is a trading range, maybe we'll test the highs. But the upside here is probably limited. Maybe a breakout point here, 54 low. We couldn't quite get there, pulled back, got there in 78. But at the top of the range, we found resistance again. 78, 79, maybe leg 3, and at the top of a trading range. So it's another good looking bull bar, 78, but the context is not good. This is also just in theory. It's too late in the day to be trading. I've heard from Ali that it's good to be flat by bar 75, so these are all bars that I do not trade. And that's going to be it for today's review. Thanks everybody for watching, and I hope everyone has a good night.